Hitting Las Vegas this week for the world's largest Bitcoin event, Bitcoin 2025. Mackenzie Sagalos is live on the scene with some highlights so far. Morning, Mackenzie.
Hey, good morning, Carl. So the vice president is set to speak shortly, and a source familiar with his remarks tells NBC News that he'll draw a sharp contrast between President Trump's crypto forward agenda and what he'll frame as Biden-era red tape that stalled the industry's growth. Now, J.D. Vance is also expected to call for clear rules and broader access to digital assets, casting crypto as something that will improve the lives of millions of Americans. Now, it comes 1 year after President Trump headlined this same event, and just 1 day after Trump media announced it had raised $2.5 billion to buy Bitcoin, potentially enriching its largest shareholder, the president. Now, Bitcoin is up 59% since his keynote last year. And on the policy front, momentum is building around stablecoins. Senator Cynthia Lummis says that she expects a Senate cloture vote on the Genius Act on Monday. And while Congress pushes forward, Robinhood CEO Vlad Tenev says crypto modernization may not require lawmakers at all.
We've actually been engaging with the SEC Crypto Task Force as well as the administration. And it's our belief, actually, that we don't even need congressional action to make tokenization real. The SEC can just do it.
House and Senate leaders here in Las Vegas say they've got the votes to get both stablecoin and market structure bills on Trump's desk before the August recess. David?
Mackenzie, thank you. Let's get a news update now. For that, we go to Silvana Hanau. Silvana.
Hey, David. Good morning. Israeli Prime Minister Benjamin Netanyahu claimed today that Israel killed another high-profile Hamas leader. Netanyahu says Hamas Gaza chief Mohammed Sinwar has been confirmed dead. He's the younger brother of the group's deceased leader, Yahya Sinwar, who masterminded the October 2023 attack on Israel that triggered Israel's war in Gaza. A Los Angeles police officer is on the stand this morning to testify about Sean Diddy Combs' alleged involvement in a break-in and Molotov cocktail attack at fellow musician Kid Cudi's home. And it comes after Combs' ex-assistant testified yesterday that her former boss wanted to kill Cudi over his relationship with Cassie Ventura. The testimony is all part of a sprawling sex trafficking trial in which Combs faces 5 criminal counts, which he has denied. And United Airlines is narrowing its window to check in for U.S. flights. Effective June 3rd, the airline will change its cutoff for most domestic flights to 45 minutes before departure. That's the same deadline for passengers checking luggage, but 15 minutes earlier than the current one for people without bags to check. Sarah, I'll send it back to you. Get to the airport early.
That is directly aimed at me and a disaster
All right,
for
well,
me.
Get there
it's
earlier.
Always late. Yeah, thank you, Silvana. Never with a bag to check. Always.
That's what the airlines ask. What does it mean for Sarah?
Yeah, exactly. No, this is a headache. This is a problem. All right, some big moves in the housing and mortgage space today to tell you about. Fannie Mae and Freddie Mac are surging again this morning after President Trump shared a post on Truth Social last night saying, quote, "Our great mortgage agencies, Fannie Mae and Freddie Mac, provide a vital service to our nation by helping hardworking Americans reach the American dream, home ownership. I am working on taking these amazing companies public, but I want to be clear, the U.S. government will keep its implicit guarantees, and I will stay strong in my position on overseeing them as president." Meantime, we've also been following shares of FICO down sharply in recent days as FHFA Director Bill Pulte calls out the company for high credit check fees, climbing today as a number of firms say the pullback might be overdone. Baird, for instance, upgrading the stock to outperform today. Wolf Research says it's a buying opportunity. The FHFA Director Bill Pulte is going to join us next hour on Money Movers to talk about all this. The FICO, what he wants to see from them, but also Fannie and Freddie and whether this time around the Trump administration will be able to do it. Remember, they've been under conservatorship. Trump 1.0, they tried to take them public. Congress got in the way because of the explicit guarantee. So how this time are they going to do the implicit guarantee? And what benefit, if any, is it going to be for homeowners and for people who need to access mortgages beyond, obviously, just the fact that they're getting out of government control and big windfall for people, investors like Bill Ackman who've owned these stocks?
Huge windfall. One of the key ways to play a Trump presidency, if you believed he was going to be victorious in the election, was this, with the idea that they would once again enter into the efforts that, to your point, Sarah, they did not complete under the first Trump administration to take these out of conservatorship, which they've been in basically since the financial crisis. So late, we're talking late '08, where they were about to fail. But to your point, I mean, they are the mortgage market. They are there as the buyer, obviously with the implicit guarantee of the U.S. government that when they issue these mortgage-backed securities made up of the mortgages they're purchasing, that the buyers can be certain they will be money good.
Yes.
And it does create a lot of liquidity for a mortgage market right now that's not particularly nearly as active, given where rates are, obviously having nothing to do with what Fannie and Freddie are doing.
No, but they've been crowding out the banks, we hear, Fannie and Freddie. Because they've offered really good rates.
Yeah, well, I mean, it's interesting because what got them in trouble in the first place was, of course, competing with the very banks that were also packaging up the mortgages that were being originated by a lot of firms that were not adhering to any sort of underwriting standards.
Quality control. Which
was really the underlying problem for the financial crisis.
We got a lot to tackle with Bill.
Yeah, a lot. Calling for lower short-term rates and a lot more. It's going to come up in the middle of the next hour. Meantime, it's been a tough year for healthcare and biotech, but one firm says that names in the space could benefit in a big way from AI. We're going to hear that case when we come right back.
And make it count.
Back, one major benefit of the AI revolution could come in the form of drug discovery. We've certainly heard that oftentimes, and it is, according to a new note from Jefferies as well, which says the technology could lead to faster development, higher success rates, and it could lower costs. Michael Yee, Jefferies senior biotech analyst, joins us now. Michael, it has been offset of late of one of the benefits of generative AI as it continues to mature. What are we talking about in terms of what you see as the real benefits to the industry, and over what time period?
Well, good to be here. You're right. It has been talked about as one of the biggest potential beneficiaries of generative AI. Jensen Huang is out there talking about that. They've got partnerships out there with biotech companies. And we know that biotech is $1 billion to find a drug in up to 10 years to get a drug to market, and 90% of drugs fail. So we think that based on analysis and some of the technologies these companies are doing, you could cut the drug time by years and cut the probabilities significantly, even half, to get drugs to market. And that could save billions of dollars and increase the odds of success and return on investment for companies and investors.
Yeah, and what time period? I mean, obviously, we're still in the early stages in terms of this technology itself, and certainly its adoption amongst companies that are developing drugs. What are you seeing on the ground right now?
Well, we've spoken with many of the big companies like Amgen, Novartis, many of the big biopharmaceutical companies that are talking about this. We have data about how many times they mentioned this. And you're correct, it is very early stage. And we're out there saying 5 years from now, we think we'll see tremendous progress in drugs that are in the clinic from test tubes today that were basically done using generative AI. So we think we're 5 years out there, but some of the big companies like Amgen particularly are talking about how they're integrating this into the early stages of discovery. So we can cut a 10-year process maybe down to 7 or 8 years.
Right. Obviously, a much greater return for your investment, conceivably. Nearer term, though, Michael, what I'm hearing from some who invest or did invest in early stage biotech is concern at the FDA. I think it's Vinay Prasad, the gentleman who oversees the Center for Biologics Evaluation and Research. The idea that they may actually make it tougher to get approvals for cancer drugs. Is that a near term concern versus this longer term potential benefit from AI?
We think in the short to medium term, you're correct. AI is a long-term thing, which I'll get to in a second. But in the short to medium term, we're obviously going under challenges as it relates to RFK, Marty McCary, and Vinay Prasad. The good news is that we think a lot of the stocks and a lot of the sector could pull up the XBI has sold off tremendously. A lot of this has been talked about. Even things about vaccines. You saw the vaccine stocks rally yesterday, even though they pulled it from the guidelines, because so much of the negative news has been priced in. Marty McCary has been out talking about how they want to push things forward, not only with rare diseases, but including with eventual integration of AI and some of the preclinical stuff that's been talked about. And so we do think a lot of the negativity has been priced in, and we do see the stocks moving up over the course of the year as investors digest what was negative headlines and probably not going to be so bad. So pay attention to what Marty McCary is saying. I think he's going to be out on listening tours with biopharmaceutical companies. I think they've talked about that. I think they'll be more on the circuit talking with the investors. We might even have them at the Jefferies Healthcare Conference. We'll see. And I think that overall, a lot of the negativity has been priced in. So we're actually optimistic for the rest of the year.
Okay. And finally, our viewers do like to hear some names. So, in terms of those companies that are going to enable the big biotech and or pharmaceutical companies to develop things more quickly, are there names? Are there companies that are actually trying to use the AI right now?
We think there's 3 ways to play it. In the big pharmaceutical area, we think Amgen is a player that has been specifically talking about the integration of it. We think Schrodinger is a software company that we think is going to benefit from increased spending on the R&D side. And then in the picks and the tools and the shovels side, Illumina and Danaher are also mentioned in the report as some of the areas where they're trying to integrate that into precision medicine and human diagnostic testing. So 3 ways to play that angle. Again, a long-term angle, but this is something that's definitely a tailwind. And again, I repeat, the FDA has been commenting more about trying to get more involved in this. And so at least they're acknowledging this. And I think there is a tailwind there to be had.
All right. Well, we'll be checking in along the way as well, Michael. Thank you,
Good
Michael
stuff.
Yee.
Thank you, guys.
Coming up after the break, could President Trump's tariffs be a good thing for Apple? Analysts at one firm making that case this morning. We'll talk about why in just 2 minutes.
As you know, Apple's been lagging this quarter as tariff fears hit the stock, but analysts out from Loop Capital with some surprisingly positive commentary this morning, arguing that tariffs could actually help pull forward demand, acting as a bridge to the iPhone 17 launch. Steve Kovac here with more on how investors should be thinking about Apple and demand around tariffs. Morning, Steve.
Hey, good morning, Sarah. Yeah, I'm not totally buying this argument that tariffs are a good thing for Apple. We've seen the reaction in the stock for that. And like you said, Loop is kind of implying here that pulling forward those iPhone 16 shipments ahead of the tariffs this spring gives us that nice setup for the iPhone 17 launch we're expecting this fall. But let me tell you what is new and notable in this report here. Loop is saying they're increasing their expectations for the iPhone Air. Now, this is that super thin model of the iPhone that's rumored to be coming this fall. Loop actually nearly doubled iPhone Air build estimates from 16 million to 33 million by the end of the year. That'd be about 30% of all iPhone 17 models expected to be produced this year. And we're going to be talking a lot about this after Apple whiffed on artificial intelligence here and missed out on a supercycle surge in iPhone sales. The real question is, can Apple make cool smartphones again? We haven't really seen any major design changes since 2020. Super cycle from AI, of course, never happened, but design changes are actually proven to spur super cycles. We have a proven track record here, like in 2014 with the bigger screens on the iPhone 6 to better compete with Samsung devices. Then you go to 2017, the iPhone 10, the anniversary edition with that new design, or 2020 with the iPhone 12, still sticking with that design 5 years later. Now, Loop supply chain checks shows that Apple thinks it might have a hit on its hands with this iPhone Air by ramping up the build so significantly. As for tariffs, though, Loop is expecting price increases for the iPhone 17 lineup. That'll help offset tariff impacts if those tariffs ever materialize. We know those 25% could be coming at the end of June. Carl, I'll send it over to you.
It's going to be an interesting cycle, Steve. Thank you. Steve Kovac on Apple today. When we come back, wealthy families getting more bullish on stocks, shifting into equities at one of the fastest paces on record. We'll talk about why in a minute.
In one of the fastest shifts in history, family offices are loading up on stocks and they're souring on private equity. Robert Frank is here. He's got some new data for us as well. Robert.
Good morning, David. Good to see you guys. Well, family offices increasing their allocation to stocks to the highest level in years. The private investment firms for wealthy families, typically worth $100 billion or more, planning to boost their stocks to 29% of their portfolios, up from 26%. Now, that was last year. American family offices even more bullish, with their stocks at 32%. All that according to a new report from UBS. Now, at the same time, they are trimming their private equity holdings, going to 35% from 27%. This marks a sweeping reversal for family offices, which, of course, had been moving to private markets away from public markets before this. Now, family offices also staying very close to home. They have 86% of their investments in the U.S. That compares to a global average of 53% of overseas investors invested in the U.S.
I think the U.S. markets have performed quite a bit better than other markets around the world. I'm sure that's part of the reason here. But I think really it's the family offices they're staying close to what they understand, what they know.
Now, to see all of the investment portfolios of today's family offices and where they're putting their money, you can get the Inside Wealth newsletter at cnbc.com/insidewealth or scan the QR code cnbc.com/Inside Wealth.
So what's the issue with private equity? I mean, I can imagine a number, including, of course, number one being fees, but what is souring them to the extent we're aware?
Exits. David, as you've reported well, there's no IPOs, there's no M&A, so you can't get money out of your private equity fund. So all that money that typically got recycled or added during fundraisers is not going back in, coupled with the fact that in public markets, the number one investment theme for family offices right now is AI. Now, unless you're lucky enough to get into OpenAI or these fundraising rounds for these big AI companies, it's all about scale. So to play AI, you really have to do it through the public market. So it's that private equity is less attractive and public markets are more attractive because that's where they can get into the AI trade.
Makes sense.
That's a good point. And at a later date, we'll talk about how higher ed is changing some of their allocations too.
Absolutely.
Under some pressure.
And they're selling a lot of their private equity because they need cash.
Right.
Yeah, these secondary funds are benefiting as a result of providing that liquidity.
That's right.
Yeah.
Robert, thanks.
Thank you,
Robert
guys.
Frank. Coming up in the next hour, FHFA Director Bill Pulte's with us. We'll talk some housing, some fresh headlines around Fannie and Freddie. You don't want to miss that as Money Movers begins in a minute.
BC Plus.
Good Wednesday morning again. Welcome to Money Movers. I'm Sarah Eisen with Carl Quintanilla, live from Post 9 of the New York Stock Exchange. Today, the countdown is on to NVIDIA, the chip giant set to report after the bell. Investors squarely focused on the impact of those export restrictions to China.
Retail's tariff trade. Macy's cutting guidance. Abercrombie expects a $50 million tariff expense. What their outlook signals about the health of the consumer.
Plus, housing in focus. Mortgage rates hitting their highest level since January. President Trump looking to take Fannie and Freddie public, and FICO facing greater federal scrutiny. We're going to discuss all of it with FHFA Director Bill Pulte in an exclusive interview this hour.
Meantime, lost a little steam. Had a nice opening bid, but the Dow's down about 100 points. S&P down about 15. All sectors are red. Communication services barely eking out a gain of just a couple hundredths of a percent. VIX back above 19 as well. That's interesting to watch. Not clear why we lost some steam, but we'll watch going into NVIDIA tonight.
Treasury yields a little bit firmer. We got a big auction later this afternoon as well on the 5-year and Fed minutes. We'll start with one of today's big retail movers, though. Abercrombie & Fitch surging more than 20%, following a beat on the top and bottom lines for the first quarter. Company did, however, pull back its full-year earnings guidance, adding that the current outlook includes the estimated impact from the tariffs, 30%. From China. Joining us now is William Blair's Dylan Carden. Dylan, it's great to have you on. You know, I spoke a little bit with Fran Horowitz, the CEO of Abercrombie, and she said, we control what we can control. She's never seen a time when consumers weren't under pressure, but because of their playbook, what they're doing, particularly at Hollister, is working. So what's priced in at this point in terms of a retailer that's really connecting well with the consumer in this kind of environment?
Sure. Yeah. And I mean, Hollister's doing well. Abercrombie's rolling over, right? We're kind of playing a game here of trying to catch a little bit of a falling knife. The expectation is that Abercrombie recovers by the back part of the year. I'm sure she told you that. The risk would be that Hollister, if it follows a similar trajectory that Abercrombie did, starts rolling over around a similar time, right? So I think the expectation here is that Abercrombie kind of sustains weakness. People are going to kind of second guess when Hollister starts to really decelerate. And then you're just sort of picking a multiple on a lower margin, right? So the earnings power of this business, $8-9, if you kind of revert back to historical margins, what do you price that at? Historical range is 8-12 times, excuse me. So we're just kind of trying to pick the number from that.
Yeah, well, I should mention you've been on hold at the name $77 price target. So we're about, $20, almost above that price. But Dylan, the broader theme here is that it's a tougher environment for retail. You see that with the conservative outlooks, the tariffs, the uncertainty on the part of the consumer. How do you pick standouts? I mean, Hollister with more than 20% comps in this kind of environment is impressive, but there are others. Dick's also doing quite well. How do you pick the winners?
Really, the way that you save yourself in this space is picking tangible growth. Really, that comes down to store growth as a general rule. Otherwise, you're kind of jumping between trends. Abercrombie is a great example of that, right? It kind of caught fire in 23. Abercrombie, the brand, ran away. Then it kind of started to decelerate because there's no real underlying, store growth, truthfully, to that. It was more or less a trend that they sort of hopped in on. Maybe that was back to work. It was a denim cycle quite clearly. If you look at other companies like an Aritzia, Boot Barn, those are companies, Warby Parker, I would put in that category, that have real tangible opportunity to grow stores. That tends to be where you see longer term sustainable upside to shares.
Dylan, inventory up almost double the rate of sales. Can you talk about how tariff is altering the order cycle going into certainly back to school and holiday?
Yeah, so 6% in units, they say. So clearly there's a higher freight component in there. Maybe there's some tariff in there as well. I would also suspect that they are under a more normalized Abercrombie cadence, right? Just from a sort of a throughput standpoint. So maybe and they even said they got a little bit more carryover, or more normalized carryover. I think what good companies coming kind of through April didn't adjust their supply chains too dramatically, right? I think there was some expectation that tariffs would ease. You're seeing that. And so I think that, there wasn't much of a pull forward or pause for a lot of these companies as it relates to inventory.
So how long do the inventories last? If they have built up inventories, and that's why we haven't seen necessarily big price hikes for the consumer, how many months does that go on? And then what happens?
Personally, I don't think there's a lot of pricing power in this space. To answer your actual question, there's about 6 months, right? So if you go to April, really you're looking at this sort of tariff impacted inventory flowing through late summer into the holiday period, right? A lot of people are now prepping uniform sort of consensus is it's 10% across the board, 30% in China. That's what Abercrombie essentially committed to today. Yeah. If you look, though, over time, going back to the mid-90s, inflation in the apparel space has been effectively flat to down, right? There's just been no pricing power in this category, crowded out by non-discretionary healthcare, housing, education. In the pandemic or coming out of it, this group took 10% price increase across the board over 2 years. That leaves them, I think, in a relatively precarious place now to push price, should they have to on a 10% tariff. I think certain brands, and On, for example, does have very real pricing power. Other companies that are competing against themselves in sort of a general fashion category like an Abercrombie versus an American Eagle, I think have more precarious pricing situations coming into the back end.
All right, Dylan, we'll leave it there. Thank you very much for weighing in on some of the big retail movers. Dylan Carden from William Blair.
Turn to the broader market this morning. Our next guest says we're currently in a wait-and-see territory when it comes to the economy. Joining us this morning, Citi Research U.S. equity strategist Drew Pettit. Drew, good to have you. Thanks for joining us today.
Yeah, morning, Carl.
I did notice there's a Reuters poll looking at year-end S&P targets. It's right at 5,900. It does seem like we're sort of frozen in place. Question is, what are we waiting to see, I guess?
Well, it's the wait and see is kind of twofold here. Number one, rates. I think that's adding a lot of pressure on growth to deliver and just the trailing multiples that you're paying for the index. So that's one. And then number two, it's the macro conditions here. Is the consumer going to be able to handle this? And then what is the ultimate end game on tariffs and the budget bill? So wait and see on the policy front, wait and see on the macro front, and then kind of wait and see on the rates front as well.
Do you think it's a matter of waiting for July 4th or whenever we get this bill done in the Senate, or an X date, or the expiration of this pause? When do you think we can start to make some decisions up or down?
So that's part of it. But honestly, I think earnings is really what's driving this market. We always like to tie it back to the equity market fundamentals. And yeah, valuations being high, rates being high, it's a concern, but growth is the way to alleviate that concern. So yeah, let's get the policy noise kind of out of the way, and let's get back to focusing on the productivity measures and what U.S. companies are doing in the face of all of that. So earnings to us, I think that's going to be a massive focal point for the rest of the year.
But wait and see strategy doesn't really work in this environment, Drew. If you waited and see, you'd miss a 20+% rally in the S&P from April 7th.
Yeah, it's not whether you're in or out, to be honest with you. It's what you're going to own through this. And for us, while you're in wait and see mode, you own growth. We've really liked the NASDAQ here. We think that's a really good place to go get beta in this type of messy market. We don't like small cap for its beta. I think in a wait and see mode, I think higher beta small cap stocks are really going to feel the brunt of, all of this concern. There you need rates lower and the macro to get better. Until we get both of those and that all clear, I think you stay in kind of your growth winners right now.
Although lower rates have been sort of a central part of the Citi house view for a while, right?
Yeah, that's the issue. Look, our rate strategy team sees kind of 410 as a base case for year end with a bear case at 485. So, we're kind of split in the middle between those two right now. But that's predicated on an economics view that sees deceleration and slowdown. So I really don't think you can buy small cap, buy high beta, buy cyclicals if you get just one out of two of those check boxes. So that's where I think growth becomes defensive in this market. Growth is what you can hold.
Right. And that does afford the Fed some room to cut. When are you penciling in the first cut?
Look, mid-year, I think the key here is our economics team just sees 2 to 3 more cuts than the market's pricing in. That's created some stability at the front end of the curve, and stability at the front end helps us kind of keep fair value in the S&P at, let's call it 22 and a half times trailing earnings.
And with the 30-year back above 5 at the moment we're now speaking, does that also provide some relief to the long end? We're going to talk about this with Bill Pulte in a few moments.
Yeah, look, for us, like the longer end of the curve, at least kind of thinking through an equity lens, we think more about the 10-year, less about the 30-year in some kind of ownership peculiarities there. But look, I think you need some stability there, maybe even some curve flattening. We should probably expect that for the kind of back half of the year. To us, both of those things probably offset themselves for, tying this back to equity markets. Look, need the Fed to cut. You need the 10-year to find some stability, and we need growth to hang in there if we want these equity markets to really break out of this range we've been stuck in as of late.
Right. Yep, it's definitely familiar territory that we're mining. Drew, appreciate it. Good seeing you again. Drew Pettit over
thank
at
you for
Citi.
having me.
When we come back, investors paying some close attention to the impact of these chip restrictions on NVIDIA results tonight. Former head of the Defense Department's AI strategy will join us with more on what to watch for and any roadblocks the company might be facing when Money Movers comes right back.
Now and make it count.
Welcome back to Money Movers. NVIDIA, of course, gearing up to report after the bell tonight. The focus this quarter is about trade restriction following NVIDIA's $5.5 billion write-down on the inventory on the heels of the Trump administration's China export restrictions. Joining us this morning is the former head of the Defense Department's AI strategy, Gregory Allen. Gregory is now serving as the director of Wadhwani AI Center at the Center for Strategic and International Studies. Gregory, thanks for the help today. Appreciate it.
Hey, thanks for having me. It's good to be back.
You've helped us work through this before, coming off of GTC. How the demand side on data center we can talk about in a minute, but how do you think the company and Jensen Huang frame the issue of restrictions relative to their earnings?
Well, it's a pretty remarkable story that they've told. I mean, they're talking about a $5.5 billion inventory write-off. That is an extraordinary amount of money. the largest, or at least one of the largest, write-offs in history. And that's because NVIDIA was banking that the Trump administration was not going to block their exports of these H20 AI chips, the chips that NVIDIA specifically designed to comply with prior export controls that the Biden administration has adopted. But the Trump administration has gotten tougher on China, even as it has gotten lighter on restrictions that the Biden administration placed on other places around the world, like the UAE, like Saudi Arabia, where multiple $100 billion deals were announced. And so in these upcoming earnings, what we're going to learn is not just the full impact of that write-off and what NVIDIA inspects for its future business in China, but also just how much of that pie in the Middle East NVIDIA is going to get.
Right. Was it, do you think the company miscalculated the universality of China hawkishness? Or maybe they also didn't count on the degree to which Middle Eastern investment might be an offset?
So I think right now, NVIDIA is taking a strategy in Washington, D.C. of publicly praising the parts of the Trump administration's policy that they like repealing the Biden administration's AI diffusion rule, like brokering these deals with Middle Eastern countries, but loudly criticizing parts of the Trump administration policy that they don't like the chip export controls on China, which really have their roots in the first Trump administration. Export controls on Huawei were doubled down upon by the Biden administration, and now were tripled down upon by the second Trump administration. And if you think about the companies that have had success in influencing the Trump administration, it's the ones that tend to keep their differences with Trump administration policy private. And just after the Trump administration handed NVIDIA a win, now NVIDIA is turning around and criticizing the Trump administration. Folks who I've talked to who are in the Trump administration say that the people who were trying to help NVIDIA feel blindsided by this loud criticism just after they helped deliver a win.
Yeah, I mean, I don't know. It feels like they have a good relationship, those two, the president and Jensen. So, Greg, since you were in the Defense Department, what about security? What about the security issue that is underlying all of this? Is it a better strategy to what they did, cancel the diffusion, make these deals with the Gulf countries to ally them away from China, or the export controls that the Biden administration put in place?
Well, the export controls that the Biden administration put in place really were targeted at China, even when they weren't targeted at China. And what I mean by that is that the AI diffusion rule was very concerned with the idea of chip smuggling. What happens when we sell chips to countries where the buyers may appear to be legitimate, but are actually fronts for China? And what the Trump administration has said is that they're going to do away with the parts of the diffusion rule, such as the cap on the maximum number of chips that key countries can buy, such as the UAE, such as Saudi Arabia. But they're going to find a way to keep or replace with equivalently strict concerns around physical security of those chips and cybersecurity of those chips to try and stop the smuggling. So the Trump administration is not denying the overall national security risk of China's rise in AI, including AI for national security and military and intelligence applications. But what they're saying is that that has to be weighed against the benefits of broad adoption of American technology. They're seeing.
Yeah, no, it's a good point. So it sounds like you're more in favor of what they're doing, but isn't China just doing it anyway on their own?
So China has a number of advantages in AI and has for a long time, but they also have a number of challenges in AI. So when you talk about the number of AI researchers, AI developers, China is world-class and has been world-class for more than 5 years at this point. But when you talk about specifically competing with NVIDIA, coming up with AI chips, the servers that power data centers, Huawei has a good offering, but it's 5 times less energy efficient. So that means if you are, for example, trying to build a 1 gigawatt data center to process trillions and trillions of AI tokens for large language models, in China, you have to build a 5 gigawatt power plant to power that same data center for compute equivalent. And that's just on the hardware performance disadvantages. On the software side, NVIDIA's advantages are even stronger.
I was going to say, I wonder, do you think we've seen the last sort of DeepSeek-driven dent to the AI build-out story, or is there more to come on that front?
Well, as I said last time, DeepSeek really reflects part of the failure of the Biden administration strategy in that they drew the performance specifications too weakly. DeepSeek was trained on chips that were sold to China legally. And now what we've seen is that the chip restrictions have become much, much harsher under the Trump administration. You really can only sell a very degraded chip to China, and that is a huge challenge for them. OpenAI CEO Sam Altman in April said, "All I do all day is call people and beg for GPUs." That's just how extraordinary the demand is for these chips. And there's a big difference between doing what DeepSeek did, which is train a admittedly very impressive AI model one time, and doing what OpenAI does, which is train world-class models and then serve them to 500 million users every week. The real computing demand is on the inference side, serving these models to massive user bases, and that's where those compute restrictions are really biting China right now. In fact, the head of Tencent, one of the Chinese tech giants, the head of their cloud computing unit, said just last month that the number one challenge facing his company is these compute restrictions. They're absolutely having an impact.
Finally, one last question, sort of, it's a step removed from NVIDIA, but it's this interview in Axios this morning with the head of Anthropic, basically arguing that entry-level, white-collar jobs are going to be dramatically cut by the inclusion of AI, not in 10 years, but in the next 1 to 5 years, where unemployment, he argues, could go north of 10%. Is that a widely held view?
It is a remarkably widely held view amongst the folks who are involved in these technologies. And the reason why that's the case is that they've seen the pace of exponential growth. Most people are familiar with Moore's Law, which talks about how computing performance goes twice as good, 4 times as good, 8 times as good, 16 times as good. But the rate of progress in AI technology is more like 10 times as good, 100 times as good, 1,000 times as good. So even if you're a worker who sees what AI can do today, and you say, hey, this can't do my job, and it seems a long way away from doing my job, the CEO of Anthropic agrees with you, but he also believes that we're 2 to 3 years away from AI models that are 100 or 1,000 times as good as what we have today. And that's why this kind of revolution may be pretty far away in performance, but might not be that far away in terms of years.
Right.
He said spiking the unemployment rate to 10 to 20% in the next 1 to 5 years.
1 to 5
People
years.
should stop sugarcoating it. Boy.
Gregory, it's hard to envision, but the market at large is trying to get its arms around it. Appreciate the help. Thank you very much.
Thank you.
Quick programming note, by the way, of course, NVIDIA's Jensen Huang, a first on CNBC interview tonight, 6 p.m. Eastern Time on Mad Money.
Coming up on this show, President says he's working to take Fannie Mae and Freddie Mac public. We're going to be joined by the head of the Federal Housing Finance Agency in charge of all of that, Bill Pulte, who oversees those mortgage giants. Plus, we'll get reaction to his comments, I should say, about FICA, which caused those shares to plummet over the past week, though rebounding this morning. We're back in a moment on Money Movers.
Why?
Welcome back. Check out shares of Fair Isaac, the top gainer on the S&P this morning. Shares recovering there after plunging yesterday following a tweet from the director of the Federal Housing Finance Agency saying, quote, still not happy with FICO. We reached out to FICO for comment, and they directed us to a blog post saying, quote, the royalty FICO collects for the FICO score is the lowest among all other components commonly used in mortgage closing costs, defending themselves there. Also on the housing front, the president says he's looking to take Fannie and Freddie public again. And just moments ago, Fannie Mae unveiling a new initiative with Palantir to use AI to help combat mortgage fraud. Got a lot to talk about with our next guest. Joining us in an exclusive interview from Fannie Mae's headquarters, FHFA Director Bill Pulte. He's also the chairman of Fannie Mae and Freddie Mac. It's great to have you, Mr. Chairman. I mean, there's so much
Thank
news.
You, Sarah.
I think the biggest one is the president saying that he's seriously considering and ready to take these companies public or privatize them, as it were. The shares are moving a lot. What's going to make this time different? They tried this and Trump won.
Well, these are the two largest companies in the world, as far as I'm concerned, in terms of asset size. At Fannie Mae, we have $4.3 trillion, if you can believe that, on our balance sheet. At Freddie Mac, we have over $3 trillion. It's almost criminal that no president until President Trump became really interested and drove these companies. So, first of all, we're very grateful that the president is interested in these companies. You know, he essentially leads it because he's actually the only one who can hire and fire this position that I'm in. So, we're very happy that the president is focused on this. I would point you to his tweet. He very explicitly says that he wants to take them public. He did not say that he wants to privatize them and many of the other things that are out there. I think that these businesses have a ton of value. Sarah, I think these businesses one day could be worth trillions of dollars, and we'll see what the president ultimately decides.
What is the why? Why you would want to take these companies public? How does it help homeowners?
Well, first of all, think about it this way. In some ways, there is one security that is publicly traded, but you have a very somewhat complicated capital structure as it is right now. One of the interesting things, too, is that the Supreme Court ruled in 2021 that the FHFA director could be fired by the president. That is very different from President Trump's first term. So President Trump now has control over the Federal Housing Finance Agency as well as U.S. Treasury, and this opens up all kinds of ideas. So whether the president decides to sell a small piece or what have you, that's entirely up to the president. But I think the opportunities are endless, and if there's one person who knows how to make a deal, it's going to be President Trump.
So I guess, okay, so we haven't figured out, I guess, the contours of how much would go into fully public. What about the implicit guarantees? What exactly does that mean? And how is it different than explicit guarantees?
Well, we're currently in an implicit guarantee environment, a lot of people say. We are in conservatorship. Interestingly, the president has not said anything that he wants to end conservatorship. We're studying, actually, potentially keeping it in conservatorship and taking it public. However, this would be entirely up to the president. He is essentially the conservator, and it works well now, but there are opportunities, like we said, to monetize this asset, but ultimately it will be up to the president how and when he wants to, if he even wants to monetize the asset.
What are you recommending? What are you proposing to him?
Well, I'd rather not say what I'm specifically recommending, but I do believe that the president is doing a great job with inflation. I think he's doing a great job with home ownership. And I think these are two businesses, frankly, that could benefit from him continuing to be in control of it. And that's why he said, I believe last night, or at least this is what his tweet said, that he would be staying in control and running them. And I think that's a very good thing for America. We need somebody who understands interest rates and housing and mortgages, and President Trump understands all of those.
But clearly, Bill, you must be at least sounding out the MBS market, the bond market, with ideas of how they would receive any of these scenarios that you're laying out. How do you keep them from remembering the hot stove of 2008?
Well, that's something that Secretary Besson, Secretary Lutnick, and I are working on, and ultimately we'll brief the president, but it will be the president's decision. I actually think that some of the things that the president has said could compress spreads. Why? Because he's taking an interest in this. I mean, we've never had a president that has been this interested in these companies. Carl, we had 16,000 people at Fannie and Freddie. Virtually nobody was showing up in these offices, Carl. You had food being made everywhere. The staff was there to make the food, but nobody was there to eat it. So we are getting these businesses to run as businesses, and I'm very grateful that the president is supporting us. And look, it'll be up to him to decide what he wants to do, but I'm very confident he'll make the right decision.
I just want to get one theory or one risk that's talked about commonly as a result of ending conservatorship, and I know you said that's up to the president and you haven't made a decision yet, is that they would have to hold more capital to absorb losses, and that could put upward pressure on mortgage rates. And that's definitely something that we don't want to see right now. Is that true?
Well, what could be very interesting is keeping it in conservatorship and going public. But this will be up to the president, and we'll look at it. We'll study it. Secretary Bessent, Secretary Lutnick, and I are very committed to making sure that the mortgage bond market doesn't have any interruption. We want a safe and sound market. We will have a safe and sound market. And like Secretary Bessent said, we hope to see mortgage spreads compress if and when we were to do anything.
Yeah, we've been hoping for that day where we get to see a little more compression in the spread. I've noted you've been pretty vocal, Bill, on Twitter, telling the Fed chair he needs to lower rates to undo the damage you argue that the President Biden did to the mortgage market. But we do know that the average 30-year fixed is higher now than it was in September when we first got that 50 basis point cut. What gives you the confidence that a trim by the Fed would give us relief in the mortgage market?
Well, Chairman Powell, who I, sit on the FSOC board with, it's nothing personal. It's just I don't understand why, if inflation is where it is right now, which is lower than the last 2 or 3 times he cut it, why isn't he cutting it right now? It doesn't make sense. I mean, you tell me, why did he cut it right before the election, but now when inflation is lower, he's not cutting? I think I know why. I'd like to not say, but I really would like to see rates get cut. I support the president in that regard. And I believe that it would also really help the housing market, Carl. Because he was too late last time, people got locked into these rates in these homes. And now you have basically existing home sales, which are in the tank for the last 4 years. Nobody was buying existing homes for the most part for the last 4 years. We need to get that inventory going, Carl, to get this housing supply churning in this country. And when you have people trapped with these interest rates, it's very hard to get that existing housing supply moving.
Yeah, we saw the figures for April, not good on existing. Is there a magic number that you think would get things moving?
Well, certainly some action to just reduce it would be helpful. I think he could make a world of difference, and I know the president feels strongly about this, and I follow the president's lead on this. He's got a great gut instinct, but in addition to the instinct is you look at Powell. He was cutting rates when inflation was higher. President Trump has come into office. He's reduced egg prices, reduced gas prices. We've even seen it in housing products, Carl. Housing products are down.
I'll just defend Powell for a moment. The reason they cut in fall wasn't the election. It was because they were worried about the job market, because we started to see a few very bad job reports. And so they wanted to get ahead of any weakness there. And what we've seen since then is the job market's been very healthy and very robust through the last few months, which doesn't really increase the urgency for them to cut rates.
Well, the urgency is that you have a housing market that would greatly benefit, in my view, from lower interest rates because it would get existing home sales going and restore the American dream quicker. I think that the president will be successful no matter what, but I just, you're asking my opinion. I think that Jerome Powell should be cutting rates, and I think it would greatly help the housing market.
I think the housing market, the industry would agree with you on that. On FICO, so you've been complaining, you're not happy with them. What sort of changes do you want to see, and what exactly are you not happy about?
Well, they passed on a 40% price increase that I don't think had any legitimate basis to do it. But as you know, at Federal Housing FHFA, we are complying with the president's executive order to reduce housing costs. He's made getting inflation down a big priority, and we're going to continue to do it. And I just see that we need to have competition. One of my roles in this regulator position, Sarah, is literally it says that we need to make sure that there's a competitive environment. And why are they passing 40% price increases on? So I think it's tone deaf, and I think that they have a lot of work to do. And I'll tell you, I've been in this job now for 9 weeks, and I've heard a lot from a lot of different people about a lot of different companies, and I've never heard so many people being upset as I have with FICO.
What can you do about it?
Well, we'll see. We're going to be making some decisions. These days, FICO was great, and I'm sure it still is a great company. But, in the age of automation and AI, credit scores, we need to just make sure that they're as low cost as possible. We want companies to thrive. We want to stay out of companies' businesses. But when they're passing 40% price increases on, when people can't, for the last 4 years, afford the American dream, we're exploring all ways to reduce costs, and this is just one of them. I don't even know if it has to do with my tweets, the stock price. I'd be surprised, frankly, because my tweets were somewhat.
I think it did.
Bill, your tweet took FICO down the biggest single day stock performance to the downside in 20 years.
But that may say more about FICO than it does about my tweets, respectfully, right? It's not normal for somebody to be able to tweet and have it affect the stock price like that. So it also begs the question, what is FICO doing? What are they doing to innovate? And, that will be for the markets to decide, not us. Again, I'm just focused as the regulator on reducing costs.
But does the FHFA, what I'm trying to understand, have the authority to change the pricing model of FICO?
Well, we are looking, as you know, at Fannie Mae and Freddie Mac. We are looking at every way to reduce costs. And that includes the credit pulls. That includes which companies we have doing things. A lot of people say that FICO has a quasi or natural monopoly. So we're talking with all the different companies. And again, I have nothing against FICO, but I'm just saying that they need to be careful with the cost because they've attracted a lot of attention and people in our industry are very upset, Sarah.
I just got one more, Bill, on Fannie Freddie. And I mean, you were around for 2008. You remember the financial crisis. We talked a lot about it this morning with Kramer. I just wonder what you remember from that era and how much of that lesson for the economy sort of informs your current view about the markets.
Well, they're absolutely critical, and I appreciate the question because $7.8 trillion is in these companies, Carl, and we have a president that is finally interested in these assets. It's a great thing. I mean, I don't know why these other presidents weren't interested in it. So I welcome the president's support. He'll make the right decision. The market will be safe and sound. And I actually think MBS spreads may compress over time. And like I said, we're studying all avenues. But at the end of the day, we're running these things like businesses. And Carl, mark my words, in a year, 2, 3, 5 years from now, these businesses will be stronger than ever before and way more valuable than ever before.
Well, the valuable investors are certainly excited. I think Congress has to be on board as well. But Bill, while we have you, I do want to hear about this Palantir partnership and with Fannie Mae and how it's going to cut down on mortgage-related fraud, which is a big issue.
It is. Palantir is going to be great. We have $7.8 trillion, like I said. We have mortgages that haven't really benefited from having AI applied across it. We've been very big, Sarah, as you may have seen, on occupancy fraud and some of these things. Fraud increases price. Again, it doesn't have to do with FICO or title insurance or what have you. Anywhere where there's a way to take out cost, we're looking at doing it as long as it doesn't jeopardize safety and soundness. And fraud is one of them. So Alex Karp, I've been very impressed with him. We'll probably also see if they can help Freddie, maybe also invite XAI to look at that as well. But I think we're going to be stunned with some of the fraud we see. I don't think it's a systemic issue, but definitely we don't want fraud in our mortgage markets.
Got a lot going on. Any timeline on all of this? I mean, clearly you're picking the issues: affordability, Fannie, Freddie. Can we expect a timeline here? Weeks, months?
We're working very hard. We're working in Trump time. We're going to keep working in Trump time, getting things done as long as it doesn't jeopardize safety and soundness. And a lot of people have said you guys have done a lot. Well, all we're doing is following the law and the statute. If it's not in the law and it's not in the statute, we're not doing it. And these are not social engineering things. These are mortgage companies now, and we're going to run them like businesses in a safe and sound manner, and that's what we're focused on doing.
Well, Bill, thank you for joining us to talk through it all. Very newsy.
Thank you.
We appreciate it. Bill
Thank
Pulte,
you.
FHFA Director.
Still ahead this morning, there's a growing disconnect in AI that could test investor patience. What it all means ahead of NVIDIA results tonight when Money Movers comes right back.
Crypto Watch is sponsored by Crypto.com. Crypto.com is America's premier crypto platform.
Hitch.com.
Meta is reportedly shaking up its AI team after months of delays on that latest Llama 4 behemoth model. Could it signal the debate around slowing AI progress is reemerging? Our Deirdre Bose is looking into that for today's Tech Check. Morning, Dee.
Hey, good morning, Carl. So that Meta shakeup delay, along with other signs of slowed momentum, it really underscores a disconnect in AI between spending and progress that could test investor patience just as NVIDIA gears up to report tonight. Now, earlier on in the race, we got model advances. It seemed like every few months. Now, however, it's longer windows between upgrades. You've got delays, and even Anthropic's latest Claude models, they show some mixed gains. Now, these are Anthropic's own numbers. Claude Opus 4 improves on coding tasks, but it barely edges out rivals on reasoning, and it actually falls behind OpenAI on visual tasks and math. Tool use, that is a key step towards autonomous agents, that barely moved. And in its own tests, the model resorted to blackmail in rare scenarios. And that is certainly a troubling result for companies whose edge is supposed to be safety. Now, Meta's edge, let's talk about it. It is and has been open source. But even with Llama, the company is struggling to ship. And the latest restructuring splits its AI efforts into two teams. There's one for products and one for AGI research. Now, this is all meant to speed up output, but it's also an admission to investors that their AI org may have been pointed in the wrong direction. Then there's DeepSeek's highly anticipated R2 model, which still hasn't arrived. Instead, the Chinese lab just quietly announced a minor trial upgrade to R1. There's no details, no benchmarks, and no timeline for what comes next. Now, this is the same startup that shook markets in January with a model that claimed to rival our best ones for a fraction of the cost. But questions around R2 could raise further questions about whether that early hype was actually sustainable. Now, put this all together, mixed model performance, slower release cycles, a major reorg at Meta, it all adds up to that growing disconnect. And even without the breakthroughs, though, guys, usage, it is surging, and that's powering demand for inference chips and infrastructure. NVIDIA is still the biggest beneficiary there. But investors may start asking, as they have before, how long can the spend justify itself?
So what is the fund? Is there a common reason for the delays across the group, or is it sort of unique case by case?
There is a common thread. I mean, and we started to see this late last year, and that is the so-called data wall, right? We're just running out of data to train these models on. So you go up instead on reasoning with Jensen Huang, which many others have talked about, and that has provided those gains, but more on the inference side. But it is notable that we still don't have sort of that killer app beyond, ChatGPT and the chatbots, and that's what sort of hurt the AI trade for most of this year, right? We didn't see that. And then we had DeepSeek come along, and there's still questions there that haven't been answered. So I think, going into NVIDIA tonight, the key question is inference enough to sort of make up for that, for the training that we're lacking right now? We talked about sovereign AI yesterday. Is that enough? But these are questions when you see these models' progress stalling that we come back to again.
Got it. We'll look for all of that. Thank you, Deirdre. Deirdre Bosa. When we come back, the read-through from Okta results for the rest of the software industry. That one's a big mover, down almost 14%. Money Movers will be right back.